So mortgage payments in Canada are about to spike, and CMHC just confirmed that many of us feared. Over 2 million Canadian mortgages are coming up for renewal between now through 2026, and most will cost a lot more. And here's the scary part. A huge number of Canadians are not even ready for this. In Toronto, thousands of condo owners who bought during the 2020-2021 boom are now staring down at payments that may jump by 30, 40, even 60%. CMHC says it clearly. They're seeing a sharp increase in delinquencies in certain parts of the country. And yes, it's happening even while national rates are still low. So what happens next? And how do you protect your home and your sanity before that renewal letter shows up in the mail? Well, stick around because later in the video, I'll show you 3 things you can do right now to soften the blow. Hi there, I'm Claudia Ragona, one of the Ragona sisters, and today we're diving into what CMHC, Equifax, TD, and CTV News are all pointing to, a mortgage reckoning that's quietly unfolding across Canada. So if you bought during the pandemic or are renewing this year through next year, this video is your reality check. And if you're one of the 2 million renewals, don't forget to hit that subscribe button. This is the channel where we break it down for real. So let's start with the facts. CMHC says mortgage delinquencies are rising. Still low overall, yes, but are rising. In 2022, the rate was 0.14%. By the second quarter of this year, it's already at 0.22%. That may sound small, but a sharp rise from historic lows is a canary in the coal mine. CMHC's deputy chief economist told CTV News, "My overall expectation is that delinquencies and arrears will be trending upwards." And then he dropped this: higher mortgage costs could put downward pressure on the economy as households adjust. So what's the translation here? Well, if mortgage payments go up, people spend less, businesses start pulling back, builders get nervous, job creation slows, and home prices stall, or worse, drop. And here's who CMHC is especially worried about: condo owners, especially in Toronto, who bought during the pandemic years. They paid high prices, they got low rates, and now those 5-year terms are coming due, and most of them took fixed rate mortgages. But those renewals, wow, well, they're gonna sting. It's the exact pressure cooker scenario. Condo prices didn't spike like detached homes did. Unemployment is still high in the GTA, and now mortgage payments are jumping right as budgets are already maxed out. And you're not imagining it. This is a perfect storm, and it's spreading. Vancouver and Montreal are next. Alberta might fare better, but even they aren't immune. There are 3 powerful forces pushing Canadians toward a payment cliff. The first one is interest rates are still 3 or more points higher than 5 years ago. And that's the average jump for renewal right now. So if you locked in, let's say under 2%, and you're probably looking at, mid 4s or in the 5s on renewal, that could mean a $400 to $1,000 more payment per month. Second, the pandemic rush to buy condos. Condos were like the affordable option when detached homes became unattainable. But those who bought in Toronto in 2020 or 2021 got hit with the inflated prices and took on large mortgages to compete. Now, prices have barely moved. In fact, we're seeing prices going downward, but the debt costs are skyrocketing. Third, overconfidence in fixed rates. A lot of Canadians felt safe because they chose fixed terms. But guess what? Most of those terms were 5 years. That clock is now ticking, and according to the Bank of Canada, 60% of all outstanding mortgages will renew through 2026, and most at higher rates. And here's the dirty secret no one's talking about. Mortgage fraud is quietly adding a dangerous layer to the entire crisis. So let me tell you what just happened in Ontario. So 2 mortgage agents were hit with $230,000 in penalties after a regulator investigation exposed a trail of off-book deals, fake documents, and reckless behavior that ended with an investor losing over $624,000 on a gas station mortgage. The 2 agents, I won't even attempt their name, but I'll put it here on the screen. They facilitated fraudulent lending outside their brokerage's knowledge, and they faked or failed to verify appraisal documents, didn't meet with the borrower or confirm identity. They took massive commissions, over $55,000 on just one deal alone, and ran the money outside the brokerage oversight. They lied to regulators until they were pressed, then admitted to processing deals without proper controls. And this wasn't just sloppiness, it was deliberate. The agent even arranged a mortgage on a gas station for a borrower who turned out to be using a false corporate identity. Wow, that property obviously defaulted. One investor lost six figures, and these agents, they got to keep their commissions. And this is the kind of behavior that regulators say facilitated dishonesty, fraud, and illegal conduct. Now, here's the terrifying part. How many of those loans approved with faked income or ignored documents are part of the 2 million mortgages up for renewal? You may have a squeaky clean mortgage. You might have done everything right, but if your neighbors, your comparables, or the buyers who propped up your price to go through the roof through shady means, you're still affected, because fraud just doesn't hurt the lender. It shakes trust, it triggers investor pullout, it tightens credit, and when rates rise, this leads to concentrated collapses. And the scary part of this is many of those fraudulent mortgages haven't even failed yet. They're still performing on paper. But what happens when those fake incomes can't support double the payment? And what happens when inflated appraisals no longer match reality? That's when the default starts. Quietly but quickly, and with ripple effects. So let me be clear. This isn't about isolated bad apples. This is about a structural rot that's been allowed to creep in, and it's hiding inside of Canada's mortgage renewal wave. So let's talk about rate expectations. A July TD Bank reports some Canadians are actually paying less now due to a slight drop in variable rates. But see, that's misleading. TD Economists warns that doesn't account for the renewal wave still coming. A false sense of calm is spreading. Many Canadians believe they're safe, but they're forgetting the 5-year term. They're forgetting the fine print, and they're definitely forgetting what happens when housing slows down and your payment jumps 40%. According to a recent survey from Yahoo Finance, more than 50% of Canadian homeowners said that they were confused about whether to lock in now or stay variable. And over 30% admitted they hadn't even run the numbers on what a renewal would even look like. That's not just risky, guys, that's dangerous. This kind of uncertainty means more homeowners will wait too long, miss the signs, get hit with the payment they simply can't manage. And worse, many Canadians are already juggling other debts. Credit card debt is rising, lines of credit are ballooning, and savings, well, according to Stats Can, household savings dropped below pre-pandemic levels for the first time since 2019. That's the backdrop we're facing, a country of homeowners entering renewals with more debt, less savings, and way more financial stress. So let's talk about what we can do today. There are 3 critical steps to prepare for. First, run a worst case renewal test. I can't stress this enough. Don't assume your lender will work with you when rates rise, and don't assume your budget can stretch. Go to a mortgage calculator right now. Take your current balance, plug in the rate that's 3% higher than what you're paying today. Look at what that monthly payment is. Ask yourself, can you still afford it? Now take it one step further. Add other monthly obligations like your credit cards, line of credit, childcare, car payments. What's left? If your answer is not much, or worse, negative, you need to act now. I can't stress that enough. And if you're a homeowner who can't afford your home, that's fantastic. That's great. But assess that affordability, honestly. And if you realize you can't afford your home under those renewal terms, it's better to assess that today, not when it's too late. Too many people wait until the final 60 days before a renewal. And honestly, that's a huge mistake, because if you decide to sell when everyone else is also scrambling to sell, you could lose tens of thousands, even hundreds in resale value. The market doesn't give you sympathy. If it floods with distressed listings, buyers will take their pick and your leverage is gone. It disappears. That's why early action is protection. Second, check for red flags in your own mortgage file. This one's very critical. Did your broker, the one you use, now gone silent? Was your income padded to make the numbers work? Did your appraisal seem suspiciously high? Maybe your paperwork wasn't clean. But if you're not 100% sure, pull the file and read it again. Reach out to the broker or the lender. Ask questions now before your renewal window shrinks. Because if there is something fishy in your application, your lender might not renew you at all. And at that point, your options narrow fast, especially if the property value has dropped. So please don't guess, don't wait, don't hope it works out. You need to prepare now so you can control the next move and not the bank. Third, start reducing other debt and build a cash buffer. A 3-month buffer can be the difference between making your payment or falling behind. And here's one bonus tip. Call your lender early. Don't wait for the letter. Lenders are more flexible when you approach them proactively, and some will offer blended rates or longer amortization options to soften the blow. So, just to recap here, over 2 million mortgages are renewing. CMHC is warning delinquencies are rising, and a hidden layer of mortgage fraud is baked into the system. And don't forget to hit that subscribe button. This is where we tell you like it is. So, I gotta say something. I heard another podcaster ask something that really got people fired up. That is, should homeowners who use fake income to get a mortgage be forced to sell, even if they made their payments on time? I want to ask you guys, what do you guys think? Is it fraud no matter what, or is it unfair to punish people who've kept up with their payments while the system looked the other way? Comment below. I want to hear from you guys. Thanks for watching. See you in the next one.